hour and a half, and then we are breaking for dinner. And the fantastic news is that dinner is provided for everybody here tonight. So thank you to whoever organized that. And that is in room 311. Is that correct? At the end of the hallway? Okay. Somebody gave me a room number, and now it's left my mind completely.
That's it.
311? See, I wasn't losing it. Okay, on page 33, we're going to get back into the system. Now, when I left my program, guys, if I could please have your attention. The thing is, I'm not going to try and talk over you guys. I'm getting over laryngitis, so I'm actually really happy to have this microphone. But if you could just please give me your attention, I will not keep you late. I will not make you come back early from any breaks or anything like that, as long as I can keep your attention, you know, when we're supposed to be focused on this. So page 33, we're getting back into the rent roll. The last thing we talked about was our cash flow. So we want to get back into the input screen. Remember, you have a couple of ways to do that. If you're like me, you can hit F4. So that's what I'll do now, F4. Sometimes you can use that function key and hit F4 as well. Or you can go to the Home Viewing tab and again use those Show Hide buttons. So that's the last time I'll remind you of the multiple ways you have to move back and forth. And to find our rent roll, we need to navigate to the Tenant's Parent tab and our rent roll sub-tab. So on the rent roll, we have a lot of areas for input, and I did mention to you, we've got within Argus Enterprise 3 different valuation methods, right? So when we look at the rent roll, if you start scrolling across, you are going to notice there's a lot of areas for input here, and not all of them are going to be relevant to our input. So before we get a single tenant into our building and start building in that additional revenue, that rental revenue, we want to clean up this view. Now, for example, I'm not going to be using traditional valuation. And you'll notice up here at the top of the rent roll, right underneath my sub-tab, if you're in version 11.5 like me, you will see what we call a quick click grid. And this has been added for our user's convenience. This allows you to scroll a little bit quicker by going to different columns within the rent roll. So I don't need to see all of these things. I'm not going to use straight line in our training session, so I don't need to see gap rent. I don't need these additional valuation methods. So before we enter in a tenant, we're going to practice creating a custom view together. And once you create a custom view, you can actually save it so that you can use it from one session to the next, no matter what property you're viewing, which is really convenient. Then we don't have all those extras. We have to scroll and scroll and scroll and tab and tab and tab. So first of all, to create a custom view, we're going to the View tab at the top of the screen. And I'll just make sure we are all looking at the AE default view, correct? Yeah, me too. So the AE default view is everything. And you'll see I have multiple views here to choose from. As you create your own custom views, you can toggle between all of the views you have available. Now we want to start by creating a custom view. So I'm moving down to the rent roll itself. I have these larger headers that are called bands. And you can think of them like rubber bands. They hold together all of the individual columns beneath. So I have the bands and then the individual columns on the lower row. What I'm going to do here is right-click on either a band or a column, and I'm going to select the option Column Band Chooser, which is what we see on page 33. So Column Band Chooser, and that causes a customization toolbox to appear in the bottom right-hand corner of our window. I'm going to drag this over to the middle of the screen, 1, so everybody can easily see, but 2, when I create a custom view, I'm going to be hiding from my view what I don't want to see. Is there a question back here?
No, sorry.
Question? Okay. And so to hide things that I don't want to see, all I have to do is drag and drop them into this toolbox. So our custom view is on page 34. And on page 34, this is listed alphabetically for you. First, the columns that we're hiding from our view, and then the larger bands, those bigger headers. I'm going to call these out as you see them moving left to right. So whatever is easier for you, you can either follow me or go your own way. Page 34 has everything we're hiding. I'm going to start with my tenure column. And remember, we're using those smaller columns, the individual headers first. So I start with tenure. This is related to UK methodology. It has nothing to do with our North American valuations here. So I'm going to pull in tenure to the toolbox and release. It's hidden from the view. Right? So we're hiding things we don't want to see. After tenure, I'm going to hide alternate area. And this is just a reference area. It happens that we're not using it in our training. So I'm going to pull in alternate area into my toolbox. After alternate area, I'm hiding lease execution. So I haven't had to scroll quite yet. I'm hiding lease execution next, pulling it in. And after that, I'm hiding lease breaks. And I do now have to scroll ever so slightly, but not too far, to see lease breaks. It's before I get to rental income. So I'll pull lease breaks into the toolbox. Sorry? No? Good? Okay. I'm going to actually scroll into the rental income band because there are 4 columns I'm hiding from my view underneath rental income. The first is going to be payment schedule, and these are all related to UK methodology. The next is rental value unit. After that, rental value, and then rental value inflation. I have one more individual column that I'm hiding. And the last individual column is security deposit. Now I do have to scroll to find that. It's going to be underneath the miscellaneous items header or band. So I'm scrolling past CPI, gap rent, percentage rent, and recoveries. And then I see miscellaneous items. I'm pulling in the security deposit column header. All right, so those are our individual columns. What you can also do is hide the bands. If you don't need an entire section of information and you hide the whole band, that hides all the individual columns beneath. Yeah?
What were the last 2 that you pulled in?
Those last 2 was security deposit, and before that it was rental value inflation. But you've got all of them on page 34 as well. I'm sorry?
Can you bring them back?
Mm-hmm.
Highlight the same way?
That's a great question, yes. You can pull anything that you've put in the toolbox back out and put it anywhere you want.
Oh.
So what you could do, maybe you don't want to hide columns from your view, maybe you just want to reorder it. So instead of hiding things, you just want what you're not using at the end of the row. So you could even reorder your columns and save that as a custom view. What I'm going to do is now hide some larger bands. So I'm going to scroll myself back to the left side of the screen, and I'm going to start with the reference band. So we see name and then reference. So I'll pull that reference band into the toolbox, and it does a couple of things. One, it has hidden reference and lease ID, but also it is updating our quick click grid when we do that, okay? So after reference, we've got the 4 bands we're hiding on the bottom of page 34. The next one I'm hiding is gap rent. I have to scroll past general, past rental income, past CPI before I see gap rent. So I'll pull that into our toolbox. And then last of all, I'm hiding that UK valuation method and that Australian valuation method. And that's scrolling almost all the way out to the right-hand side of our screen. We're looking first for traditional valuation. We'll pull that in. And then we're looking for capitalization valuation. Pull that in. Now, once you have finished updating your custom view, you can close the toolbox if you're finished making edits, and I am. So I'm going to close that customization toolbox. I've got a little red X to close it.
How do we bring it back if we want to?
That's a great question as well. If you need to bring that back, You can right-click just the same way we got it there. So right-click on a band or a column. Column band chooser, and it pulls it up with everything in it that you've hidden. Okay? So for now, I'll close that, but what I need to do is save the view, because closing that toolbox does not automatically save this view. So if I want to save this and make sure I can use it in future properties that I look at, I can go up to that View tab. I currently see AE Default View selected, and I'm looking for this drop-down arrow next to all of my views. When you click that drop-down arrow, you're going down to Save as New View. And now we can call this My Rent Roll View. The Share with Others checkbox is there if you are on a shared license. So that means one person could set up a view and then push it out to everybody that they share their license with. So everybody gets the same view of the program. And I will point out that this custom view we created, that's specific to the rent roll. So remember I mentioned back on revenues and expenses, you've got that UK functionality apply to tenants that we're not using. Creating a custom view for the rent roll does not automatically hide those things back on expenses. So you can create custom views for each screen where you have columns for input you don't need to see. I'll click OK to save the view. And you'll notice now we can toggle back to the AE default view. I will make sure I'm viewing the My Rent Roll view. And the last thing I'll say about custom views is that you do need to pay attention when it comes to custom views, because if information is entered in a column, but that column is maybe on your screen, hidden from your view, keep in mind that the information is not deleted, it's just hidden from your view. So all of that information can still be used in the valuation of your asset. So just something to be careful there with those custom views. I'll go ahead and turn over to page 36, and we're finished with that View tab. So I'm going to return to the Home tab at the top of my screen so that I can see all of my home ribbon functionality. And here on the rent roll, we can model existing or prospective tenant lease terms that we know the specifics for. I can add a record to this screen the same way as any other. So what's one way I can add a record to this screen?
Right click.
Yeah, there we go. I can right-click and add a record. And we get a single line item here now. So we will use the details that we see on page 36. Our tenant is Inigo Montoya Enterprise. So where it says enter item name, Inigo Montoya Enterprise. And I'm just tabbing across through this row. Inigo will be in suite 100 of our building, and their lease status is set to contract. We'll talk about your other options here as we keep building out the rent roll. So for now, lease status set to contract. Question?
Yes, let's say I have the same information in Excel. Can I export it into Argus?
So there are a couple of ways that you can get information from Excel into Argus Enterprise. We have an Excel add-in that you can use to push information back and forth. You also can copy and paste from Excel. So you've got a couple of options there. Their lease type will be office, and their area measure will affect the occupancy of our building. Right now, they'll take up the entire building. So their area measure will be 60,000 square feet. Now I have 4 columns that follow that seem indistinguishable from one another. I see available, available date, start, and start date. And they sound like they're talking about the same thing, but in fact they are referring to 2 different things. So your available and available date columns are referring to when the space itself is available. So what physical space is available. Then the start and start date columns are referring to when the lease commences. So we'll talk a little bit later about what happens if there's a discrepancy between the available and start dates. But for now, we're going to let those dates match one another. The space will be available on the specified date of June 1st, 2018, and the lease will start on the available date. I'm actually going to tie those two together through the start column. I'm toggling to the available date setting, and when I tab over, you'll notice that grays out the start date. That means if I update when these space is available, if I update that available date, that passes through to the start date and updates when the lease commences as well, okay? The next thing I'll enter is the tenant's lease term, so I'm moving over to the term/expire column. Right now, it reads 5/0, which means 5 years and 0 months. So if you see a number slash another number, that's years/months, right? You can also enter a fixed date for when the lease ends in this field, which would be month, day, year, or it would be based on your computer settings. So however you enter dates on your computer, that's how it would read as well. The end column, you can't update, you can't change that end column. It's only going to interpret or read what you have in the term expire column. So again, you can enter either years and months or a fixed date in that term expire. We're going to have a lease term of 3 years, so all I'm doing is typing 3 and tabbing over, and the end date automatically updates. That'll take us into the rental income section, so I'll scroll over to rental income. When I go to the base rent unit of measure, I've got a drop-down list full of options. So I can do dollar per square foot per year or month, $1 per year or month, percent of market, or with steps. We're going to use the default in this example, dollar per square foot per year, and then in the base rent column, I can type in this tenant's base rent, $22 per square foot per year. What I'll point out is that this value remains flat through the tenant's lease term unless I manually apply escalation. So if I have a 5-year term, and I know that market inflation is always occurring in the background, right?
Yes.
Okay, some of you agree with me. So my market inflation, always applying. If my tenant comes in year 1 and they're paying me $22 per square foot, that is outside of inflation. And when they pick up that value, it remains flat unless I apply any kind of growth to that value. Now, they have a 3-year lease term, so their lease ends in year 3, and they're rolling to this inflated market rate. But again, once they pick up the market rate, that remains flat unless I apply escalation. So at this point, we are not dealing with growth when it comes to our rental revenue. We're going to talk about that when we come back from dinner this evening. Our inflation always applying in the background, but that doesn't automatically apply during the lease term, okay? So this is going to be a flat 22, and when we go back and look at our cash flow, we'll see that flat amount for 3 years. The next thing we have to enter is free rent. So continuing on to page 37, we're going to give this tenant 3 months of free rent right at the top of the lease. So I'm just entering the number 3 in the free rent column. That is, again, consecutive months given at the start of the lease term, and by default, your free rent period will include base rent, fixed steps, and CPI increases. That is a key box for you on page 37. I guarantee you it's on the exam. The next thing we see beneath free rent is our recovery structure. So we have expenses that are occurring, and how is our tenant going to help us pay for these expenses? So what page 37 tells us is this tenant has a base year stop recovery. So I have to scroll across. I'm looking for my recovery structure drop-down menu. Your default recovery structure is net, which means the tenant pays their pro rata share. Whatever portion they take up of the building, that is their share of expenses. But in this example, they're not using that recovery structure. They are using a base year stop recovery structure. When we use base year stop recovery, this is typically for office lease types. And with a base year stop, we are telling the program to calculate what expenses are what value the expenses are in the first year of the tenant's lease. In that first year, the tenant doesn't reimburse us anything for expenses. They pay nothing. We are simply establishing how much expenses are in the first year of their lease. Now going forward, it's only year one that they're not reimbursing us anything. So it's going forward every year after year one, they start paying their pro rata share of expenses over whatever the stop amount was. So that's the idea behind it. We can actually look at that. Here I have base year stop. So your formula is the expense in year X, which would be year 2, 3, and so on, minus what the expenses are in year 1, times the tenant's net share. And you can see there we have the net share calculation, the tenant area divided by the property size. So if I have this 3-year term, I establish in year 1 that my expenses are $10,000. That is the stop amount. That is the base stop amount because we're referring to the base year of the tenant's lease. And that stop amount is valid for the length of the tenant's lease term. So in year 2, when my expenses go up to $20,000, the building owner, have to pay $10,000, but the tenant is going to pay their share of $20,000 minus 10, whatever their net share is. So their net pro rata share over the stop amount. And that will continue for every year of their lease term. So any questions about that?
I have a question on the previous item of the free rent.
Sure.
So when
Let's go back to that.
I'm sorry.
Yeah, that's okay.
So when I click on the ellipsis there,
Yes.
it says month 1, amount 3.
Yes,
And that's correct?
that's correct.
Okay.
So what that is referring to, and what's your name?
Sebastian.
Sebastian? What Sebastian sees is he actually went into the free rent ellipses here. And he sees here month 1, which is January of 2018. That's the first month of the lease term. We give 3 months. That is consecutive months. So we know when the lease starts in January, we give January, February, March, all free rent. Right? Okay.
Mind going back to the base year stop slide?
Not at all. Let me get there and there.
That formula isn't in the book.
It is not, I don't think, it isn't, but you are getting my slide deck. So again, if you are panicking, thinking you will never see this again, you will. You are going to see this by the end of the week. You will own it, okay? Thank you.
For the exam, can we use a book or no?
I'm not taking the test with you, so what you do is up to you.
But can we use the book, or is the book not allowed?
We'll talk about the exam at the end of the day, okay? So that might, when we actually talk about the exam, it might answer your question a little bit more, right? But, I mean, you do you is all I can say. All right, any questions about base year stop? Nope? Okay. All right, so we're going to keep talking about different recovery structures that we have, and like I said, we'll get more complex when we get here tomorrow. For now, though, we'll keep moving. So we've got the tenants, how they're reimbursing us for expenses. I need to keep scrolling, and I'm moving next into leasing costs. So I have tenant improvements to pay out and leasing commissions. I have to pay the tenant to fit the space to their needs, so I'm going to pay tenant improvements out in the amount of $15 per square foot. I need to start with the improvements unit of measure. This is going to be $1 per area basis. But nothing becomes active until I tab over.
Excuse me.
Yes?
I have a problem with customization. I'm not able to say, I don't know how to do that.
You're not, I'm sorry, what? You're not able to
Customization. I am trying to say, but...
Oh, to create save the custom view? So,
To redo, because I was not able, I don't know how to.
it's not going to save. So for now, so the custom view is not required to use the program. So I would say for now, go past the extra columns, and when we break for lunch, let's take a look at your issue, okay? Because you can see the rent roll, right?
Yeah,
And you
I
can
have some
add a
stuff,
line?
But I went to save that view.
And it wouldn't let you? Okay, so let's troubleshoot that. For now, you're just gonna have to deal with the extra input, so just tab
I know
past.
it's very simple, but, I don't know what to find.
So we'll take a look at that on the break, okay? So our improvements then amount is $15. And then you see improvements timing, it's already set to 100%. What this means is that by default within Argus Enterprise, your tenant improvements will be paid out in the full amount, 100%, at the start of the lease. So year one, month one of the lease term. That's the default setting. Tomorrow we're going to talk about getting a little bit more complex if you have payment structures for tenant improvements or leasing commissions. So we will get into the detail of these things, but we're keeping it a little bit higher level for now. We'll leave that default payment in place. The next thing we need to enter are our leasing commissions, which we will pay out in a fixed rate every year of 5%. So I'm looking for the unit of measure, fixed percentage, because that rate remains the same over the course of their 3-year term, and I can enter the rate 3%. And I will show you the leasing commissions calculation. It is going to be your base rent plus step rent plus CPI minus the free rent times the rate, and that is for every year of the lease for the entire lease term. That is all added up, and within AE, that pays that out year one, month one of the tenant's lease. It is much more common to see a 50-50 split payment for your leasing commissions. And so we'll talk about how to structure that payment as well. Is there a question?
Yeah, the commission's paid, you put 5%, 3%, but it's 5% in the book, should we put
Oh,
it?
yes, do what the book does. I'm sorry, yes.
Yeah, okay.
Thank you for those eyes. 5%. Your commissions, and so what he pointed out here, guys, was that the book tells you to put in leasing commissions at 5%. I typed in 3, that was my bad. So make sure that you get what's in the book, 5%. Otherwise, our reports won't match. So we'll leave that commissions timing set to 100%. Now, any questions about the rent roll? All right. In that case, that takes us all the way out to the end of the rent roll, and now we're looking at market leasing. There is a default profile already in place. And when we're talking about market leasing, we're referring to, bless you, what happens to this tenant area after the original lease expires. So then what terms get picked up for the remainder of our analysis. So we want to go edit this default profile, and to do that, we're going back to our Market Parent tab and our Market Leasing sub-tab now. And we'll turn over to page 38. So you've got two key purposes for market leasing profiles within Argus Enterprise. The first is going to be to apply leasing assumptions to a tenant area when the original lease expires. So I'm a visual person. If this helps you at all, if we've got a 5-year term, I know what's happening for 3 years. That's Inigo. So we pick up in year 3 the market leasing profile, and that tells us what's happening through the end of our analysis with this tenant area. The second use for your market leasing profiles within Argus Enterprise is for the speculative lease up of vacant space in your space absorption window, and we're going to talk about that later this evening. So for now, we're really just focused on that first use of your market leasing profiles. Here on my market leasing window, I have the default profile line already inserted for me. But this is a dummy set of assumptions. It has a 50% chance of renewal and nothing else. So I need to either overwrite this line or add to it. What I'll point out to you here is that you cannot delete the default profile. So you cannot get rid of it altogether. In our case, we're going to overwrite this line. So instead of the default profile, I'm going to call this my office profile assumptions. So if someone picks up this office profile, they'll have a lease term of 5 years. I'll leave that default in place. But I'm entering here both my new market assumptions, what happens if a new tenant comes into the space, and my renewing market assumptions, what happens if my tenant renews. So I start with the renewal probability. I think my tenant's going to renew, so I'm going to enter a 75% chance of renewal. However, if they move out and I get a new tenant in the space, how many months downtime do I anticipate? That's what I enter in the months vacant column. So here I'm going to enter 6 months. So I've got to, kind of remodel the space, make it ready. I've got to find somebody to lease it. So it's going to take me 6 months from the end of the original lease to get a new lease beginning for that tenant area. Then I need to enter my new and renewing base rent. I'm going to use the unit of measure, dollar per square foot per year. My new base rent will be $22 per square foot per year. And when I tab over to renewing, you'll see that it reads same as new. You can type right over this with your numeric value. So our renewing base rent is going to be $20 per square foot per year. Continuing down page 38, the next thing we'll enter is new and renewing free rent. Now you can scroll to get there, but if you are working in version 11.5, you'll see the quick click grid at the top of your screen again. So I'm going to use my quick click to get to free rent. And that just automatically scrolls me over. Now I can enter new free rent. So to a new tenant, I'll give 3 months of free rent. And tab over, well, that automatically inserts into the renewing column. But I'm going to say that if my tenant renews, I'm not giving any more free rent. So I want to zero that out. When you tab over, you get a very intense warning here. But it's not quite as scary as it seems. It really is just referring to the one input cell. So here it says you're going to reset the values that we've auto-populated for you. If you proceed, it takes your value instead of what was auto-popped. And we're fine with that here. So yes, we do wish to proceed, and it takes our value 0 months for renewing free rent. After free rent, then we see recovery structures. I'll point out that every market leasing profile you create, the recovery structure column will default to continue prior, which means whatever was set up for the original tenant's lease term, that will continue without change into the market term. Well, I don't want a base year stop amount that was established in 2018 to still be applying 3 years down the road in a totally new lease term. So instead of continuing prior, I actually want to use base year stop again. So we establish a new stop amount for expenses when this market term begins. So I'll use base year stop as my new selection here, not continue prior. I'll move over to page 39. We've got TIs and LCs to get in. So scrolling ever so slightly, TI unit. Now we'll use the same unit of measure that we did within the rent roll. We're using a dollar per area basis here. And when I tab over, I can enter new TIs at $15 per square foot and our renewing TIs at $5 per square foot. Again, still leaving that payment year 1, month 1 in the full total. Our leasing commissions will be 5% paid out for a new tenant, but slightly lower if our tenant renews, just 2.5%. So just like we did in the rent roll, we're using a unit of measure, fixed percentage. Our new LCs at 5%, and then renewing LCs at 2.5%. I am going to scroll you all the way out to the very right-hand side, and you have a column here called upon expiration, and it reads office profile. What this last column is referring to is what happens to the tenant area after this market term that we just entered. So we said we've got the 3-year term for Inigo, then we've got this 5-year market term, and this last column says, okay, but what about after all of that? Then what do you want to apply? This column is only going to read the market leasing profiles that you have created. So right now it's saying, all right, if we use the office profile for 5 years and get to the end of that, then we'll use the market terms for another 5 years. Does that make sense? Perfect. So we've gone through and set up our office profile. We need to make sure that it is applying upon expiration to our original tenant lease term. So we've got to hop right on back to the tenant's parent tab. And we're in the rent roll sub-tab. Notice that in the market leasing column, because we wrote over the default profile line, it is automatically picking up now our office profile assumptions for what happens after expiration. And the column right next door to the market leasing column tells the program how to interpret the market leasing profile that you've applied. So you get a lot of different things to choose from in this upon expiration drop-down menu. Page 40 defines all of your upon expiration drop-down menu options. We're going to talk about a few of these. So if you select market, upon expiration market, then the program will create a blended average of values based on the renewal probability that you've entered. It will blend a little bit of your new market values with a little bit of your renewing market values to come up with a market blended average, and it will give you some projections. We don't know what's going to happen, so we just want to roll to the market terms, and it's going to blend the new and renewing values together. We'll talk about that calculation in a little bit more detail in just a second, along with the formula for how to get to your blended averages. But before we do that, I'll point out you also have a renew option. If you select renew, you're telling the program that you assume a 100% chance of renewal. The tenant is definitely renewing. So it looks to the assigned market leasing profile, and it uses 100% of your renewal column values only. No blend occurs. If instead you say upon expiration vacate, you know the tenant is moving out. There is a 0% chance of renewal. It looks to the assigned market leasing profile, and it uses only your new market assumptions for a new tenant coming into the space. Again, no blend occurring there. We'll also look at option. So if your tenant has an option to exercise, an option to renew, option is going to ignore the market leasing profile altogether. It pretends like it's not there. It automatically inserts another line into the rent roll itself. And it's a copy and paste of everything from the original lease term. And you can change everything except when the lease begins. So that option lease will start as soon as the prior lease is expired. Okay? Now in our example, upon expiration, our tenant will roll to market. Any questions about any of those upon expirations? Okay? If you think of anything, let me know. I'm happy to talk more about that stuff. But we'll say upon expiration, we're rolling to market. So I mentioned that when we use market, we're looking at blending our new and renewal values to come up with our blended market averages. And your formula, sorry, I'm getting some feedback there or something. Your formula is going to be your new value, I'm just using abbreviations here, your new value times your new probability plus your renewing value times your renewing probability to get you to your blended market average. So you can calculate that out, but the nice thing is you don't have to. If your tenant is rolling to market, the program actually has a report that gives you those values. But it's good to know that the program isn't lying to you. So there's the math behind that report. We'll go look at it now by hitting F3. And this is called the assumptions report. So your assumptions report is found in the property reports parent tab, and if you just drop straight down, you'll see the assumptions sub-tab. This report is on page 41 of your training manual. So this report is telling you what terms will apply to your tenant area after the original lease expires, depending on which upon expiration you've selected in the rent roll. So if you've selected upon expiration market, renew, or vacate, you can find your values within this report and see what terms will be picked up. The top of this report is going to have your inflation rates, which we've already entered, your capital expenditures on a dollar per square foot basis, and then we get into your general vacancy rate and your credit loss if you've included one. Beneath that, it builds out all of the market leasing profiles that you've set up within the system. So you've got the length of the lease term, the chance of renewal, you'll see the months vacant, and then a blended average. You then get the new market rent, the renewing market rent, and again, a blended average. So we see 22, 20, and then a blend of 20, 50. So we're using this formula to get to those blended averages. Starting in year 2, your market inflation begins applying to your market rates. So we can see our inflation apply from here. If our tenant is rolling to market in year 3, their lease is 3 years long, so they'll be picking up our market blend in year 4. I can tell using this report that they'll pick up $23.28. Now this isn't the only report that's going to give me that information. I can see it on other reports as well, but this is, a good spot to look. So I'll just point out that formula being used over and over again. When it comes to our market calculations, we're blending the new probability with the renewing probability. So for market, that's 22 for new times our our new probability of 25% plus our renewing value of $20 times our renewal probability of 75%, and that gets us our blended market average of 2050. And your manual on page 41 has that calculation. We do the same blend for months vacant. So we said 6 months downtime if a new tenant comes into the space. Obviously, we won't have any downtime if our tenant renews. That gives us a blend of 1.5. And you see that blend of 1.5 on the assumptions report. But I'll point out that your cash flow is going to round that number to the nearest whole number of months to calculate the number of months for absorption and turnover. Okay?
I'm sorry, I just have a quick question. Do you give us these market calculations? I know that, like, on page 41, I think that that's the market rent.
Uh-huh.
But it's not like the actual formula that was on page 25. Do you give this,
My slide deck?
yeah.
Mm-hmm.
Oh, okay. So,
Yeah.
okay.
Yeah. So your free rent, we said 3 months of free rent to a new tenant, none to our tenant that renews. That gives us a blend of 0.75. And I have a call out here. It is only months vacant that doesn't allow decimals and will round to the nearest whole number of months. So for free rent, we will actually see 0.75 months of free rent. So any questions about these calculations or the assumptions report? Yeah.
Where do we see these calculations on the assumptions report?
Well, your assumptions report isn't giving you the calculation, the formulas.
No, I mean
it's
the
giving
numbers.
you the numbers.
Yeah,
Mm-hmm.
but I didn't see them.
Okay, so let's go back to that assumptions report. Here's my months vacant, 6 months. There's my blend of 1.5. When I look at a cash flow, that will round to the nearest whole number of months.
Okay. Oh, okay.
Okay? See that?
Yeah.
So we've got our new, our renewing, and our blended values.
Okay, got it.
Perfect. So this report is there for you to see what your values are across all years, but we can take it directly to the property level cash flow on page 42 and see our values coming through. So we're in the property reports parent tab, cash flow sub tab, and I'm going to scroll to the top of the report. It's just leaving me dropped wherever I was the last time I looked at that cash flow. When I scroll back to the top of the cash flow, I can now see rental revenue occurring. So I have $22 per 60,000 square feet. And remember, we have not applied any growth to our rental revenue. So that's a flat amount for 3 years. The tenant's lease ends at the end of year 3, and they're rolling to our market values in year 4. They are rolling to an inflated amount. But again, because we haven't applied growth to that inflated amount, once they pick that number up, it remains flat through the end of the market term or our analysis in this case. Okay?
Mine has no information. Under cash flow?
Under rental revenue?
Yeah, it's just completely blank. It
So-
shows the forecast year 1 through 6, but doesn't have anything.
So for stuff like that, let's troubleshoot that on a break so that I can actually sit down and look at your computer and see what's going on. So we've got our original lease term rental revenue, we've got our market term rental revenue. We can see in year 4 when we roll, there is absorption and turnover. This is your downtime occurring between the leases. So absorption and turnover is telling us that the space is sitting vacant. It says 1.5 months on the assumptions report, but we know that's rounding to the nearest whole number of months, so we know that's representing 2 months downtime on our report here. Then we see free rent. We give 3 months of free rent to our original tenant. We give 0.75 months of free rent within the market term because we're rolling to those blended averages. Underneath rental revenue, we now have some expense recoveries. And remember that we're using a base year stop recovery structure for both the original lease and the market term. So when we use a base year stop, we see no recoveries in that first year of the tenant's lease term. They start paying their pro rata share over the stop amount in the subsequent years of the lease. So we see that set up for both of the leases that we've got here. Our roof antenna is still in place, so that hasn't been affected. Now our potential gross revenue and our effective gross revenue have gone up because we have so much more income coming through the property. Now we haven't touched any of our operating expenses, but some of those OPEXs have changed. For example, utilities is now showing the entire expense amount because we're 100% occupied. So it's passing through that full expense amount now. You'll also notice that the management fee has gone up, and that's because the effective gross revenue increased. Now the NOI is looking a little bit healthier, and below that line, we see our leasing costs. So our tenant improvements and leasing commissions paid out year 1, month 1 for the original lease, and then year 1, month 1 for the market term. When I get all the way down to the bottom of my report, you will notice we're still at negatives in years 1 and 4. In those years, we are not receiving reimbursement for our expenses. We are paying out TIs and LCs. So, any questions about the cash flow?
I'm sorry, can you tell me again what's TI and LC?
Your tenant improvements
And then you can come back.
and your leasing commissions.
Thank you.
Sure thing. All right, feeling groovy? Yeah, cool.
I have a different number for, but I'll touch base with you.
Okay, that's perfect, perfect, perfect. All right, guys, then let's go ahead and turn over to page 45. And we're going to talk for about 30 more minutes before we take our hour break. So property purchase picks up on page 45. We're getting into our investment in the property and then our valuation of the property. So I need to get back out into the input screen. I'm hitting F4 to get there. And I'm moving from the tenant's parent tab to the investment parent tab. Now I've got 3 sub-tabs here, starting with property purchase, and a lot of information on this screen is pretty locked down. It's really feeding from other areas of the program with several of these cells. So for example, the purchase date, that is your analysis begin date. The only way to change the purchase date is to change when your analysis begins. What I can change is the purchase price. So I have a drop-down menu here. I can enter a price, take a present value net of costs, or My only other option here is going to be to take a direct cap value. Now you'll notice 2 additional options. Those are related to methodologies used in other parts of the world. So we are not using our traditional valuation or our capitalization valuation. We're sticking with our DCF valuation. In this case, we're going to enter a price of $8 million. And when I tab off of this cell, I see that price feed through to the total price and the equity invested. If you have any closing costs associated with this purchase price, those closing costs can be entered in this middle section. Now you would have to add a record to the middle section, so you could right-click to add. And then you can enter closing costs as a percent of the purchase price or a dollar amount. You've got some options there. Those would feed through into the closing costs field. The other thing we're going to talk about is less debt amount. So we are going to enter a debt note on our property in the debt financing sub-tab. I will point out before we move off this screen, once you have a purchase price entered, Argus can calculate an IRR for you. So we will go ahead and move over to that debt financing sub-tab. You may have noticed the last sub-tab as well, called Other Debt. Other debt is used by our clients who feel that what we have within debt financing currently is not complex or robust enough to encompass their debt scenarios. So the Other Debt sub-tab, if quickly we want to just take a look at it, you'll notice here I'm able to add a record to the screen, and this is where I can enter my debt payment amount as well as how often it occurs. So this allows our clients to have their debt payments on their reports without Argus calculating that information for them. We are going to enter our debt note within the program. So we're back on debt financing, and I'm going to add a record to this screen. Within Argus, you can enter an unlimited number of existing or prospective loans. So I can add as much information to this screen as I want to. We will have one loan that we take out at the beginning of the analysis, and it immediately begins amortizing. I'm going to call this purchase financing, and I find that information on page 46. I have 2 loan types, amortizing and interest only. If your debt is interest only for a couple of years and then begins amortizing, you would still leave that loan type set to amortizing, but what you would do is scroll across into the loan timing section, and you have an amortized start column. This is where you can enter either the date on which amortization begins or the month number. So in my example, if I was 2 years interest only, I could enter month 25 here, and amortization would begin at that point. We won't be using that. Like I said, our loan will begin amortizing immediately. Now I'm moving over to the How Input column. I can enter this as a dollar amount, loan to value. Takeout is your refinance option. If you do have other debt notes here, takeout is refinance. What we're going to do is calculate our debt as a percent of other. So we're going to say that our debt is 50% of the purchase price. When we use percent of other, and you do have this How Input on your revenue screen and your expenses screen, percent of other allows you to calculate a value based on another line item within your cash flow. So percent of other, once I select it, transforms the amount column to interpret as a percentage. But nothing else has happened. So you'll notice if I hover over the amount cell, it says percent of line, and then it's blank, with an overall multiplier of 100%. So I haven't actually said at this point what I'm calculating off of. I've told you, but I've not told AE. So I need to go into the amount column ellipses in order to say what value I want this purchase price to be, or sorry, this debt note to be. Calculating 50% of the purchase price, I'm scrolling all the way down. And if you're looking at this percent of line listing, it is going in the order that your cash flow is calculated. So we see base rent, free rent. This is what we just saw in the cash flow. We're scrolling all the way down to find purchase price. And this is where I will enter 50%. And I'm going to tab over here. When I tab, the purchase price is now in bold, that purchase price line in bold. and I can hit OK at the bottom of this window to accept my changes. Now, when you do hit OK, you get back to the amount column, and it still says 100%. And that's a little confusing. But you can make sure that you have passed through the correct item by hovering over that ellipses again. It says percent of line with purchase price at 50%, and that's how we know we're calculating off the correct value. The reason that amount column is remaining the same is because that's your overall multiplier. So if you decrease that overall multiplier, you're then taking a percent of the percent that you've specified. So if I drop that down to 50%, I'm taking 50% of 50%. Well, then I'm looking at a quarter of my purchase price for the debt note, right? Okay. So we will keep moving. Excuse me. The next thing we'll enter is an interest rate. And on page 47, we can see our interest rate is 4%. If you have a floating rate, or if that interest rate changes over time, again, you've got an ellipses. You can go into a table and build out what that interest rate changes to at what time. I'll turn over to page 48, and page 48 takes us into this loan timing section that I mentioned earlier. So we can see the loan date is defaulting to analysis B. Yeah, Sebastian.
I have a question regarding the interest rate. If it's a floating rate based on an index, for instance,
Yeah.
how can you calculate that or you put it in the program?
Well, you would have to know what that is. There's no way for the program to, be connected to a website that feeds that rate, that changes. So you would have to go into that table yourself and update that as you see updated changes.
Okay.
Yeah. So as I was mentioning, I know this says analysis begin, but if you're ever wanting to see what's everything that this cell says, instead of just saying analysis B, you can go to the loan date column header and right-click and do a best fit or best fit all columns. I'll do a best fit here. Now, it's not super impressive on this particular column, but it does widen to the longest point of entry. So that is really helpful when you do have some lengthy text within a cell. You can actually see what that says. So we can see here the loan defaults to start at the beginning of the analysis, but like I said, you can enter existing or prospective loans. So your other option here is to go into the drop-down, choose a specified date, and then enter the begin date for the loan. We'll leave our payment schedule set to monthly. Our loan is 30 years, but it reads months here. So we enter 360 months, and that automatically updates the end date when we tab over. That's all that we'll update within our debt financing. But I'll point out here, you've got item to calc and amortization type. You can use these to change the amortization term or to enter a call or balloon date for your loan. Moving into calc method, you've got a total of 3 options here. 12 months and 360 days are used most often in the States, at least. Semi-annual was added for our Canadian clients. And your calc method, all 3 of these options are available to you in the on-screen help. So remember, you can hit that F1 key and see the difference between those 3. If you have additional principal, you can include that. Tell the program if you're recalculating your loan payment. Any loan costs can be included. So any questions about debt financing before we go look at a report? Yeah.
If I have an allowance for a draw for TIs or commissions, can we put that in the program?
So tell me this, are you saying that a portion of the loan is based on the value of TIs and LCs, or it contributes to, pays for?
Contributes.
It pays for?
Yeah. Or the availability of the draw at least.
So you can, really your only option with debt financing the way it is if you want to say that the loan is based on the cost of TIs and LCs, then you can use the percent of other like we just used.
Okay.
Go into that ellipses and say it's 100% of tenant improvements and leasing, or whatever percentage. Now, as far as being able to say that it goes towards a particular cost group, the debt financing on its own is not going to let you say, okay, this loan contributes to this specific cost group.
So it doesn't tie up to the market assumptions we just made on the leasing.
It's not going to show you that it's paying for those things.
Okay.
So there is, I'll point this out to you, and if you're interested, we can talk more about it offline. But within the File Viewing tab, you will see right underneath Property Portfolios, there is an Investment Portfolios tab, which allows you to create investment structures, waterfall distributions, where you can say that your financing contributes to specific things within your file.
Okay.
Now, that's an additional license, so it doesn't come with the basics of the program, and it won't be, your basics within debt financing, what we're looking at, wouldn't be able to do what I think you're referring to. But if you want to talk more about it offline, I'm happy to, okay?
Thank you.
Sure thing. So I'll go back to home. Any other questions about debt financing?
You can also, the bands and the items, you can customize them here, right?
Yes.
The way you view.
Yes, you can, absolutely. You can create a custom view. All right, so let's go look at our loan amortization report within the program. And I haven't saved in a while, so I am going to go ahead and save my property. Your loan amortization report is at the bottom of page 48. So I'll hit F3 to move there within my program, get into the reporting screen. And I'll point out, guys, if you are going back over this manual on your own at some point, our instructional designer has done you a favor here. She tells you you are looking for the parent tab, debt reports, and the sub-tab, loan amortization.
What page is that?
This is page 48. And then she tells you specifically which loan you are looking at. And so all of the reports that we look at in this training manual will be titled in the same way. So you'll get that parent tab and sub tab if you're ever like, I just don't even know where to find this. It gives you that. It gives you some instructions there.
The only difference between report and home are the things that you can do at the top, print, export.
Correct. Your ribbon that runs along the top.
Yeah, the ribbon.
Yeah, so we're going to be looking for the debt reports parent tab and the loan amortization sub tab. I did mention that you can enter multiple loans within your program. So if you do, you have a report for drop-down menu. You can toggle between which loan you're reporting on, or you can check a box to show them all. So this report is actually showing us that we're paying down our loan over time. It gives us the name of the loan, what type, when the loan begins, and it shows us that our loan term and amortization term, in this case, are the same. In the proceeds column, we see the initial amount being borrowed, $4 million. Your interest rate is applied, and then your amortized payments are broken down into your interest and principal payments for an ending balance that is then carried over to the following year as the beginning balance. So it's showing you you're paying that down over time. You see a balloon payment in year 5. Enterprise assumes that the loan balloons at the end of the analysis, and it uses your resale to pay that balance off. Okay? We'll go ahead and move on to page 49. And we'll get back into the inputs, F4. Just a little bit more information and a few reports to talk about before we break. So on page 49, we're looking at now our valuation parent tab. And we're going to move right into the property resale sub-tab. That's where your book picks up. But actually, what I'll do is point out direct capitalization to you. Now, it's not in your training manual, but I don't want you to feel like, oh, that's just a mystery. I just don't know what that is. So direct capitalization allows you to use a direct cap value, calculate a direct cap value if you don't have a known purchase price. So for example, if you're in acquisitions, you're trying to decide if the property is going to be worth the investment or not, you can take the NOI in year 1, divide by a direct cap rate, and that's what you can specify here, your direct cap rate, to get a direct cap value. And this direct cap value can be used back on investments and property purchase instead of entering a purchase price. You remember, there was a direct cap value option that would feed through from here, okay?
Is there a way to do it in a more, the first year obviously is misleading because you have all those free rents, etc. So any more real way to do that?
So really the only way to change what NOI is being taken into account is to go into assumptions and change this timing setting. But the thing to keep in mind is that it is also going to change the timing assumptions for the rest of the file. So you may want to change this just temporarily to get the direct cap value. I know our older program DCF had a lot more options here, and Argus Enterprise just doesn't have the options that DCF did in this regard. Yeah.
Quick question. When you change, I guess, just mess around with the direct cap rate and the direct capitalization menu, it does not affect the rest of the model, correct?
It should not be affecting the rest of the model, no, because we're not using the direct cap value.
Exactly.
Yeah. So what we'll do here is move into the property resale tab, which is where your book picks up. And what I like about this property resale screen is that you can actually enter multiple resale values here. So really, you can use Argus Enterprise to sensitize on your resale calculation without having to create multiple versions of your file. You can just enter multiple line items on the property resale screen, and this very first column default with the check mark, whatever is checked as default, that's the resale calculation that's applying to your file. Now there is already a line item entered for us. I didn't do that, you didn't do that, it just comes with the program. And that's because there is a default calc method that's already entered for you. So we'll just go ahead and write over this line that's already been inserted. I'm going to call this my resale calculation. And my date of sale is going to default to the last day of my analysis. We'll talk in just a second about how you can change that. But from this field directly, you cannot change the date of sale. We have to move a little bit further out in order to do that. Now, I mentioned to you that there is a default calc method already in place, and I'll do another best fit here. Remember, I right-click on the column header and select best fit. So now I can see my default calc method is to cap the NOI 12 months after sale, which is why we see 6 years on our analysis. So if anybody was looking at our reports and thinking, I could swear we entered 5 years, it's because of this calc method that the program is automatically creating our reversion year. Now you've got a lot of different options here. You can cap the NOI using an average of the sale and following year. You can cap the NOI in the year of sale, cap a stabilized income, inflate the purchase price, enter sale price. And I will point out, enter sale price is also what you would use if you ever need to scrub a file before you send it along to somebody else down the road. If you ever need to clear out your valuations within the file, keep in mind you cannot delete the resale calculation line. So if I need to send my file to somebody but I don't want them to see my resale calculation, I could enter a sale price at $0, and that's really the only way to effectively get rid of the resale calculation line item. In this case, I'm going to use the default, cap NOI 12 months after sale. The next thing I see is my exit or terminal cap rate. The program gives you an exit cap rate of 10%, and that's what I'll use in our example. I'll keep scrolling across. If you want to add back free rent, you have a checkbox to make that adjustment, and then you've got gross up occupancy. So you've got two calculations here, percent of occupancy and lag vacancy. Your calculations are in the on-screen help.
Sorry, so this would do what I was just suggesting for the resale price. So basically, if the year that we're basing our selling price on, if that year has free rent, and we say, well, that's not already a real cash flow, then we adding back the free rent, and then more.
Sure, you can add back the free rent, and then right next door, right past the add back, then you have a deductions as well, so you can take out things like tenant improvements and leasing commissions and free rent as well, yeah. So you can make all of those adjustments that you're referring to. But this is for the resale.
It's back to a more typical year,
Sure,
basically.
sure. Then you see hold period, and it is going to, let me do a best fit here, default to the length of the analysis, which is why we see the date of sale as the last day of the analysis. But if you want that to be something different, notice that you can enter a number of hold years or enter a fixed date. And then the last thing we have is this adjustments column. So if you have any selling costs, commissions, anything like that as a part of the resale, you can go into the ellipses for adjustments to include those items, which is what I'll do. I have on page 50, selling costs calculated as 3% of the adjusted gross sale price. So what I'm going to do here is use the Add Adjustment button to get a line on this window. And in the description, I'll point out, this is not a test question, but you can use F2 to highlight the whole cell, just like Excel. And I'll call this selling costs. We'll leave the type as selling costs and let this calculate as 3% of the adjusted gross sale price. Now what I'll point out here before I hit OK is that off to the right-hand side of our screen, we have a results window. And this is giving us a real-time results report on the resale calculation that we've just updated for the file. So we see the NOI in year 6, because we're capping NOI 12 months after sale, dividing by our exit cap rate of 10% to get our gross sale price. Now when I hit OK at the bottom of this adjustment screen, right now my selling costs are at 0. But when I hit OK, that immediately calculates and I can see my net sale price affected. So I don't have to go to the reports in order to see what I've set up here within the input screen. Okay? On page 51, we'll move over one subtab to the present value subtab. And this is the screen that allows for a calculation of a DCF value for this property. So here on this screen, within the discount rate field, we can enter our primary discount rate, our present value discount rate, or your target IRR. And in our example, we're going to use a discount rate of 15%. So I won't change anything else on this screen. I will point out that page 52 is a reference page for you on the very first subtab, Assumptions subtab. And we briefly mentioned it, but we're not really using it as a part of our training. So page 52 is reference for you. Are there any questions about our inputs before we now go look at some reports over what we've entered? All right. So I'll turn over to page 53. And we need to get into the reporting screen. I'll hit F3 to get there. We're starting with the Audit Reports Parent tab, and we're looking for the Property Resale sub-tab. I mentioned that you can have multiple resale calculations entered for the file. So you again have a Report For drop-down menu at the top of this report, or you can elect to show them all. But we get to our year 6 NOI divided by our exit cap rate. We see the gross sale price. Now this is starting to look familiar, right? We just covered this information back on the input screen. We see our selling costs deducted to get our net sale price. Well, we've got 3 extra lines on this report that you didn't have back on the input screen. So those last 3 lines are the loan balance being deducted from the net sale price to get the proceeds from sale. And then we get a present value of our net sale price, which means we're taking this net sale price and discounting at 15% that present value discount rate we just entered back to analysis begin to get this PV of net sale price. This is not the last time you will see this information. You'll get tired of it. You'll see it so often. We're going to turn over to page 54, and now we're going to look at some valuation reports. So I'm moving to the Valuation Reports Parent tab, and I'm looking for the Valuation and Return Summary sub-tab. And I like this report because it is essentially a highlight reel of your property's valuation. So it gives you this one-page overview or summary of everything that you have entered and your outcomes. Underneath valuation assumptions, you can see the inputs we've made. So we see our present value discount rate of 15%, the length of our hold period, what period we're capitalizing on, the exit cap rate being used, and you can even see the selling costs that we're applying. Underneath the valuation assumptions, we see our sales proceed calculation again. So I won't take you through the calculation for the third time, but you get the idea. It's not letting you forget how we're getting to the property's valuation. Then we see the return summary. So moving over into the next column, you have the return summary. These are your property's outcomes. So we see things like our total unleveraged present value for the property. We can see our unleveraged and leveraged IRR. So you've got a lot of KPIs on this report to deal with. Underneath the return summary, we see a distribution of net proceeds. So we're taking the net sale price minus the loan balance minus our equity invested to get to the ending proceeds. And then the very bottom of this report has unleveraged and leveraged cash-on-cash returns for every year of the analysis. Still within our valuation reports parent tab, we will look at the present value sub-tab. So this report is giving us a summary of what we would have to negotiate in today's dollars in order to achieve a target IRR. You've got unleveraged present value and leveraged present value, so without debt, and then your with option is available through a drop-down menu. And so you can see here if I want a 15% IRR, there's my 4.9 present value.
So that tells you that you're overpaying by $3 million, basically.
Thank you. On page 56, we are going to look at a couple of dashboard reports. And we are right on time to break for, I'm just going to call it dinner, because I keep wanting to call it dinner and lunch, and I can't get it straight. So we're going to break soon, in a couple of minutes, but 2 reports before we do that. Dashboard reports parent tab, and I'm starting with the property summary sub-tab. This is another one of those overview reports, giving you that high-level overview of your property's valuation. So here we can see basic inputs that we've made, the inflation rates that we've used, our weighted average lease expiration is provided. Beneath that, you'll see a summary of your year 1 cash flow. So you're getting that on an annual dollar amount as well as a rate per square foot. The middle piece of this report is taking you through your purchase and investment, valuation and yield, and debt financing inputs. And then the last piece are the 2 graphs out to the right-hand side. Now, on this particular report, you are limited to the 2 charts that you see, but you can right-click on either one to choose what information is displayed. So that's a tame property summary report. You can get wild with the custom dashboard. So if you move back out to that first sub-tab, this custom dashboard, you can update, change to include as much or as little information as you want. Now, for me, the default setting is all I have in place, but I can include an image here. I can swap out or change what I see here. You have a maximize button and an X, so if you want to get rid of an item that you see or make sure that that's all that you see, you can customize this report. And then anything, maybe you get rid of something, you want to get it back, that's done through the report options, top left-hand corner of your screen as long as you're on the report viewing tab. On the report options, I now have a list of everything I can include in the custom dashboard, as well as what's actually included on the right-hand column. So you can move things in and out, up and down, get crazy with it. So any questions about these last pieces that we covered? Yeah.
If I wanted to create a report of all the general assumptions that were taken to generate the model, what would be the best one?
That's a great question. And I'll repeat it for our online attendees. The question was, if I wanted to generate a report that had all of the basic input assumptions that I have made here, how would I go about compiling that sort of report? And the good news is you don't have to create it on your own. A report that might be really handy for that is going to the Audit Reports Parent tab. The last sub-tab you have is called Input Assumptions, and this is a text output of everything that has been modeled for the file. So it takes you through, now we haven't talked about modeling policies yet, but we will. So these are your file settings, the modeling policies. So it takes you through all of the file settings, and once you get past that, we go into property and description. Well, that's how we started building the file. We go then into our timing settings, our location, and so it takes you parent tab by sub tab and gives you that text output of everything that you've put into the program. Does that get at what you were looking for? Okay, perfect. Yeah.
Are you able to export all of this information to Excel, and if so, does it include all of the formulas?
Yes and no. So the yes part, you can pull all of this out to Excel. You have an export button in the report ribbon. So when you hit export, you select Microsoft Excel. Now I'm looking at the input assumptions report, so of course it wouldn't give me any, there's no formulas to enter here. But no matter what report it is, it will only pull out the numbers, not those formulas.
And inversely, the input, if you were to use formulas, would you be able to input them into Argus?
If you were in Excel and used formulas,
So let's say you've calculated, present value, or whatever, the IRR, and then use the formula of IRR, and I guess Argus recognized IRR and the cell next to it, which gave it the number.
so there are some instances where if you have templates set up that have those formulas and they're feeding numbers for you. I mentioned a little bit earlier there's an Excel add-in,
Yeah.
and in some instances it can't. Now it's not, the direct answer is probably no. You can't go and type in your IRR formula and Argus says, oh, okay, calculate it, got it.
Yeah, of course.
Because it has its own calculation machine getting to those numbers. So what you were asking about is a little bit more of a process where if you have a template set up with your formulas feeding into a template that the Excel add-in can read and is feeding those numbers through to the template, so you've got your formulas on a different sheet, then by way of the Excel add-in it could do,
Yeah.
but that would be a process, more of a process.
Okay.
Any other questions? All right, guys, well, we're going to break for dinner. I'm going to keep calling it that. So it is 6 o'clock. It's 6:04. Let's meet back at 7:04, and I'll go down to the dot. So 7:04, and we'll get started again. If you have questions, please grab me either now or right before we come back, but now is probably a better time to talk through any issues you might have. So I'll see you guys at 7:04.